I'm Hamish Maxwell, investment specialist, Baillie Gifford and Scottish Mortgage, which is indeed the UK's largest investment trust and Baillie Gifford's longest standing client. Scottish Mortgage is a very well-known UK investment, but some of you may be less familiar. So let me begin by dispelling a red herring in our name. In much the same way that the consumer electronics company Apple has nothing to do with selling fruit and veg, and the French luxury goods company Hermès is not literally the Greek god of wealth, fertility, and animal husbandry of the same name, so too the company Scottish Mortgage has little to do with Scotland and even less to do with mortgages. It's a legacy name from over 100 years ago when Baillie Gifford and Scottish Mortgage were both founded to work together looking for the best growth companies. We're rather fond of the name, as are many of our investors, so we've kept it. Scottish Mortgage is not about Scottish real estate. Rather, it is about the pursuit of exceptional growth. We want to own the very best growth companies from around the world and offer those returns to our investors. My presentation is about what makes Scottish Mortgage a distinctive opportunity. And if you have any questions, we'll be delighted to meet you at our stall in the main hall afterwards. Our purpose at Scottish Mortgage is simple, and that's to maximise total returns over the long term. And to do that, we seek to own a liquid and low-cost portfolio of exceptional public and private growth companies. And this is a rare combination. The businesses we want to own are addressing large and growing opportunities. They have competitive advantages, and they are disrupting or even creating new industries. And many are founder-led with a cultural advantage too. However, exceptional companies don't change or create new industries overnight. It takes 5 to 10 years or more, and there will be mistakes along the way. And that's why when we find what we think is the best growth, we need to be patient and supportive shareholders. But that, of course, is not always easy. Humans are not naturally very patient. It's just not how we evolved. Through much of our history, our ancestors had to think about hunting and agriculture in terms of the 4 seasons of the year. And it's perhaps no surprise, therefore, that the market is so obsessed with the 4 quarters of the year. But this innate short-termism jars with the requirements of the modern economy. In this age of capitalism and industry and longer life expectancy, investments must be made over multi-year, even multi-decade horizons. Converting new ideas and new technology into growing businesses takes time. But if you're successful, the rewards can be exceptional. The relationship between Scottish Mortgage and Baillie Gifford goes back over a century, and it has created excellent long-term returns. And this is our share price chart over the last 100 years. Now, apart from inevitable moments of adverse sentiment like the 1970s oil shock, dot-com bust, GFC, and post-COVID, Scottish Mortgage has otherwise been a very successful investment over the long term. And it's pleasing for us to have delivered these good long-term returns. And looking forward, as I'll explain, we believe there's lots more to be excited about for the patient investor. We think that good growth investing requires certain characteristics which are hard to find in the investment industry. And I'll make the case that Scottish Mortgage embodies 5 characteristics which make it a distinctive opportunity. I'll do that over the next 15 minutes or so. And these characteristics are listed here, and I'll cover them in turn. We are not interested in the status quo. We are interested in new ways of doing things, in the future, and in growth. The first characteristic, seeking outliers. Now, please don't feel the need to read the dense footnote. Just now, I'll talk us through the big picture. The asymmetry of stock market returns is very clear, and it should inform decisions about equity investing. And by the way, asymmetry is just a longer way of saying skew. The stock market is made of thousands of companies, but returns are not evenly distributed across every company. Rather, the biggest returns come from just a few businesses. Now, the extent of this skew often surprises people, even the most experienced investors. A study by Professor Hendrik Bessenbinder from Arizona State University and this is what is being shown here, of the 61,000 listed companies globally since 1990, 61% of them underperformed T-bills, which are US government short-term bonds, so basically the risk-free rate. 38% of all the listed companies merely offset that value destruction, so only 1.3% of all listed companies created all of the wealth above T-bills, which was $44 trillion. In other words, when you're looking for the best returns, only a few companies actually matter. Now, to own the biggest winners, you can invest either passively in the whole market, in which case you're guaranteed to own them because you own the whole market. But your returns will be diluted with the 98%, which equate to T-bills. Or you can back a stock picking process that aims to invest in just the biggest winners, in which case your returns might be exceptional. Asymmetry has been at work in the Scottish mortgage portfolio, and our good long-term returns have been driven by a few big winners. Now, inevitably, we experience some losses in some of our holdings, and we're quite open about this fact. For instance, Northvolt, one of our private companies in the battery industry, recently struggled through lower than expected demand and problems ramping up. And you can see that in the biggest losses we made along the bottom of the page here. However, the most you can lose in one company, in one investment, is the original investment in that company. Whereas the upside from your biggest winners is theoretically limitless. For instance, Nvidia, the AI chip company we invested in 2016, has grown 100 times in the last 10 years. Tesla, we bought in 2013, grew 35 times in size before we started selling it down last year. Ferrari and semiconductor company ASML have each grown around 10 times. For example, our biggest winners substantially outsize the biggest losses. That is the nature of long-term, long-only equity portfolios. Now, the best performing long-term growth companies are also often the most volatile in the short term. This is important to recognize. For example, look at Nvidia over the period we've owned it and Spotify. Good long-term returns are periodically punctuated by volatility, and that's shown in the orange bubbles. Now, the reason for this is that different variables play out over different horizons. Long-term returns follow profits, so companies that grow their profits 5 or 10 times in a decade will be worth more as a result, for instance. Whereas over the short term, share prices are unpredictable. And this is because, stating the obvious, future profit growth hasn't happened yet. It must be forecast. And the market's ability, indeed its willingness to forecast profits, is affected by all sorts of things like the sentiment of the news, by new presidents of the United States, by trading volumes and lots of other unpredictable factors. For instance, to seek the best rewards, we need to look to the long term and recognize there will be short-term volatility. This brings us to the second characteristic, our belief that change drives growth. If you want to invest in just the biggest winners, one approach is to look for the companies driving valuable change, such as new science, new technology, new business models, and new demand. The link between change and growth is the intuitive combination of two facts. One, profits drive share price over the long term. I'll say that a few times during this talk. And two, consumers prefer to spend their money on new and better products and services, which some companies, some visionary companies, go about providing. Now think of all the valuable industrial revolutions that came before us: steam, electricity, flight, computers. But now think of industrial revolution as ongoing: AI, genetics, robotics, connectivity. Today, the global stock market, all of the listed companies around the world, is worth a staggering $70 trillion. But most of its thousands of companies are being disrupted over the long term by a few big winners. Now, here is the big opportunity for the investor. On screen, we're showing examples of growth trends in the Scottish mortgage portfolio. For example, we have the evolution of transportation up here with electric vehicles, BYD, drone delivery, Zipline, and air taxi company Joby. We have the digitization of finance with investments in Stripe and Wise, and we have the transformation of healthcare with companies like Tempus and Recursion using technology to improve life expectancy. for 10 years, potentially more. These are just to name a few examples of companies in our portfolio driving change and therefore seeking market share. To look deeper into one example, artificial intelligence or AI, after decades and decades of science fiction and investment, AI is finally here and it is changing the world. The rise of AI has been a contributor to market returns recently, so it's worth exploring a little bit. Phase one is the hardware that makes AI possible. And at the heart of the supply chain, you find three of our holdings: NVIDIA, ASML, and TSMC. NVIDIA designs the best chips for AI. TSMC makes those chips for companies like NVIDIA, and it does that better than anyone else. And it does so using ASML's machinery. But then downstream, next you've got the infrastructure companies. So these are companies using AI chips to create huge and valuable AI models, like cloud providers, network infrastructure, data, security. And our investments include Amazon, Meta, Snowflake, and Databricks. Intriguing is the third category, the applications, arguably the broadest of all. This is where companies are using AI to improve their revenue or reduce their costs, or both. For example, in our portfolio, we've got Recursion using AI to find new drugs to treat people, and Shopify using it for e-commerce. So lots of exciting examples of AI driving change and therefore driving growth. Third characteristic that gives us an edge is our structure as an investment trust, which we've had for 116 years. As a closed-end fund, so basically we sell a certain number of shares to raise a certain amount of capital, and it's those shares that are owned by our investors, and that capital we invest for growth. Because of this structure, we can focus on long-term investments without the need to liquidate assets prematurely for cash flow. We aim to actively manage our share price around net asset value through issuing or buying back shares. And we have recently been in a period of greater than usual discount, so the board has been actively buying back shares. We employ some modest gearing or borrowing to enhance returns. Now, returns must exceed the cost of borrowing to help, not hinder. But historically, our careful use of borrowing has contributed to returns. As the UK's largest investment trust and a member of the FTSE 100, liquidity is there when you need it. We are about the long term, but we recognise that you do have periodic needs for liquidity. And we keep our fees low at 0.35%. So that is well below the industry average to allow our investors to keep more of the returns. And the last point on this is that our structure also allows us to have up to 30% of the portfolio in private companies. Our private companies are illiquid, but our closed-end trust allows us to offer them in a liquid form. This brings us to the fourth characteristic that gives us an edge, which is our private company exposure. Many growth companies are now staying private for longer, so the relevance of private companies is increasing, particularly to growth investors. The average age of an American company, for instance, at listing, has gone from 8 years in the year 2000 to 12 years today. And the amount of value in late-stage private companies has gone from $10 billion about 20 years ago to $2 trillion today. Right, so there's a lot of capital being accumulated in late stage, and if you ignore it, you're missing a lot of growth. For us, it's the growth we're looking for. The pre or post IPO is arbitrary distinction. Our blend of public and private, in other words, is exposure across more of the company's growth cycle. Private companies are currently around 26% of our portfolio, and this includes 6 of the world's top 10 most valuable private businesses. Our largest position is SpaceX at 7% of the portfolio. SpaceX is leading in low-cost space logistics and satellite internet connectivity. We invested when it was worth $30 billion. Now it's worth $350 billion. We have ByteDance, which is another of the world's largest private companies and owner of TikTok. I'm not sure if we have any budding TikTok stars in the audience. I'm going to ask you to raise your hand and do your dance. Ian Bruce, I'm looking at you back there. We invested in ByteDance when it was worth $75 billion, and now it's worth $300 billion. We also have Stripe, which is digitizing payments and making inroads to cryptocurrency, among other examples. Our private portfolio has strong fundamentals. Half are cash flow generative and others are on path to profitability. And you can see these here. Private companies get to choose their shareholders. That's a really important distinction with public markets. Our reputation as long-term supportive shareholders means we are often preferred investors, particularly for founders who will approach us seeking investment, or they'll introduce us as well. And that gives us access to high-quality deals and long relationships with visionary people. We've got a really well-resourced private companies team at Baillie Gifford, an evaluation process that our investors can trust. And again, this means a broader opportunity for investors. I think this is one of the most significant developments that's happened in our generation of investing, the change in private companies. And this, I think, is truly exciting. The fifth and final characteristic that makes Scottish Mortgage a distinctive investment is our mindset. And we do aspire to be curious, patient, and brave. Curiosity matters because to beat the market, you need different views to the market. And we don't focus on the short-termism or the consensus of the finance industry, however comforting that might feel in the short term. We think it's wrong to do in the long term. Our information sources are open-minded, such as academics, research groups, expert networks, and private companies, helping us see growth coming down the line. And we view growth trends like renewables, like healthcare, as real-world problems requiring practical solutions, not as abstract financial concepts. Patience matters because it's about taking risk, and driving valuable change does not happen overnight. It takes 5 to 10 years or more. And the evidence shows that the market is obsessed with the short term. This is where turnover figures generally exist in the market, whereas our average holding period is nearer 10 years. You have to give companies the opportunity to drive the change they're aspiring to. And if you do, that can mean the capture of compound growth that others might miss. And bravery matters, again, because reward comes from taking risk. Now here we're showing a high active share and different concentrations to the market. We have to stand apart from the crowd, again, however uncomfortable that might feel, and we need the courage to invest in transformational growth, even when it's out of favor, because we're pursuing the growth that other people might not. The result is a portfolio that has delivered strong sales and earnings growth compared to the benchmark, which is exactly what we're looking for. 2 to 3 times greater than the benchmark on a delivered view and a forward view. And again, the reason this matters is because regardless of market sentiment in the short term, it is revenue and it is profits that will drive share price over the long term. The evidence of that is absolutely clear. It really matters. In summary, our purpose at Scottish Mortgage is simple, and that is to maximize total returns over the long term for our investors. And we aim to do that by offering something distinctive, a liquid and low-cost portfolio of exceptional public and private growth companies.